Welcome to Iron Financial, the place where we forge stronger portfolios by putting the market's biggest names right on the anvil. Today, we're taking a look at Apollo Global Management. They've just released their full year 2025 earnings, and believe me, the headline numbers are absolutely massive. But you know us, we don't do headlines. We get under the hood, we check the welds, and we find the weak points. So, let's get right into it.
Okay, let's just start with the sheer scale of this thing. By the end of 2025, Apollo was sitting on nearly $1 trillion in assets under management, $938 billion to be exact. I mean, we're not just talking about a company here. This is a financial ecosystem that could literally swallow entire industries. Now, a number this big, it commands respect, for sure, but it also demands extreme scrutiny. Because when you're dealing with a balance sheet this massive, even the smallest crack can lead to a catastrophic failure. So our job today is to figure out if this thing is a fortress of finance or just a house of cards waiting for a strong breeze.
First up, we're going to build the bull case. You have to understand why the market is so excited about this name. And honestly, when you look at their 2025 performance, it's pretty easy to see why. Management is out there calling this a year of exceptional execution. They're talking about laying the foundation for what they call the next generation of financial services. So let's look at the raw materials they're using to build this fortress, piece by powerful piece.
It all starts with inflows. Capital is the lifeblood of any asset manager, and Apollo is pulling it in like a super magnet. $228 billion in total inflows for the year. That is a record number for them. And what that tells you is that investors, from the huge institutions all the way down to individual wealth clients, they're voting with their wallets. They trust Apollo to put their money to work, and they are sending it over by the truckload. This isn't just a little bit of growth. This is a massive expansion of their capital base, and it gives them more firepower than ever before.
But look, attracting all that capital, that's only half the battle. The real heavy lifting is deploying it effectively. And this is where Apollo is just operating on a whole other level. $309 billion in origination activity. Now, let's be really clear about what that means. This is not about just going out and buying some stocks and bonds on the open market like everyone else. Origination means they are literally creating their own investment opportunities from scratch. They're lending money directly to companies, they're structuring incredibly complex real estate deals, they're building assets that just wouldn't exist otherwise. This is the hard work, the heavy lifting that builds the very foundation of their earnings power.
Now, what I really find fascinating about this chart is that it proves this isn't just empty asset growth. This is profitable, durable, repeatable growth. We're looking at what's called fee-related earnings, or FRE. The easiest way to think about this is, it's the stable, predictable income stream Apollo gets from managing all that capital, and it doesn't matter if the market is up or down. And it jumped from just over $2 billion in 2024 to over $2.5 billion in 2025. That is a 23% increase. Look, in this economy, any company that can grow its core, predictable earnings by 23% year over year is an absolute machine. This is the structural steel of their entire earnings report.
And this right here, this just perfectly shows the confidence coming straight from the top. The CEO, Mark Rowan, he's not just talking about a good quarter, he's talking about a fundamental shift in the whole financial landscape, with Apollo leading the charge. He's framing their success not as some lucky break from market conditions, but as the result of a deliberate, well-executed strategy to build something new, something that lasts. He's basically saying, we're not just participating in the market anymore, we are the market. It's a bold statement for sure, and it perfectly sums up the bull case for this behemoth.
All right, hold on a second. That is a very polished, very nice story. Fortress, structural steel, next generation of finance. I mean, it all sounds fantastic coming from management, doesn't it? But here at Iron Financial, we don't just take the CEO's word for it. When numbers look this good and the story sounds this perfect, it is our job, our duty to be skeptical. It's time to take a hammer to this foundation and see if we can find any cracks. Because let's be honest, when a structure gets this big, this fast, you really have to start worrying about what might be hidden just beneath the surface.
So, the real question, the one that really matters, is this. Is that foundation truly solid? The lead analyst has laid out a really compelling case for a financial fortress, I'll give him that. But every fortress, every single one, has a potential weakness, a hidden passage, a flaw in the design. And as I'm looking at this report, I'm seeing a few things that don't quite line up with this perfect picture of invincibility. So let's apply some real pressure here and see what happens.
Okay, let's start right here. This is the first thing that should be a giant red flag for any serious investor. Just look at these two sets of numbers. Down on the bottom, you've got adjusted net income. That's the number the company wants you to focus on. And yeah, it's up nicely, from about $4.5 billion to over $5 billion. Great. But now look at the top line, GAAP net income. That's the official, audited, by-the-book number. And it went down by over $1 billion. Now, whenever a company's favorite adjusted metric is going up while the official accounting profit is falling off a cliff, you have to ask why. What are they adjusting out? Things like stock-based compensation for executives, acquisition costs, expenses that management would just rather you ignore. When the gap between the official number and the adjusted number gets this wide, it's a huge warning sign that the quality of their earnings might not be as rock solid as they claim.
Now let's move into the engine room. Athene, which is Apollo's retirement services business, is an absolutely core part of their earnings power. The whole thing works by earning a spread, basically the difference between what their investments make and what they have to pay out on their insurance products. Now look at this trend. The net spread has compressed. It's fallen from 1.38% down to 1.23%. Now I know 15 basis points might not sound like a lot to you, but on a portfolio of hundreds of billions of dollars, that represents a significant and direct hit to their profit margins. So is this just a one-off issue caused by weird market conditions, or is it the start of a really dangerous trend? This is a clear sign of potential stress in one of their most important business lines.
And finally, we have to look outside the company's own walls. This fortress doesn't exist in a vacuum. Just last week, we saw the whole market get rattled by fears over AI disruption. The big worry is that this new technology could just completely upend the investment thesis for entire sectors of the economy, like software. Now, Apollo was quick to say they have very little direct exposure, but that's not the point. The point is that unforeseen external shocks are always a risk. A company as massive and as complex as Apollo is exposed to the entire economy. So yeah, they might be dodging the AI wallet today, but what's the next black swan event? A structure this large makes a very, very big target. So while the analyst is focused on the fortress walls, I'm getting worried about that black swan flying right overhead.
Okay, those are fair points. Scrutiny is absolutely necessary, and you're right to point out the gap divergence and the spread compression. But you're focusing on hairline cracks in the facade while you're completely ignoring the bedrock the entire structure is built on. You're worried about a black swan, but you're forgetting that this company built a frickin' ark. These are details, yes, important details, but they do not change the fundamental strength of the business model. To really understand why Apollo is built to last, you have to look inside the engine. Let's really see how this thing is built.
Look, Apollo's whole strategy is built on 3 deeply integrated pillars. It's a system. First, you have origination, which we've already talked about. This is their unmatched ability to just create their own investment assets. We're going to drill into that more in a second. Second, you have global wealth. This is their distribution machine, getting those products into the hands of a massive and growing base of individual investors. And third, capital solutions. This is their ability to provide custom, flexible financing to businesses of all shapes and sizes. The key is that these 3 pieces don't work in isolation. They feed each other. Origination creates the product that global wealth sells, and capital solutions generates even more origination opportunities. It's a powerful, self-reinforcing flywheel.
And this right here, this is the core of my entire rebuttal. That $309 billion number we saw earlier, it's not just some vanity metric. It's the key to absolutely everything. Apollo is not just a passive asset manager, it is an asset originator. In a world where high-quality yield is getting harder and harder to find, where everyone is fighting over the same public assets, Apollo has built a factory that produces it at scale. They are not price takers subject to the whims of the market, they are price makers. This control over their own supply chain of assets is their single biggest competitive advantage. It's what allows them to manage spreads and find value where nobody else can. And this chart directly addresses your concerns about risk. You see cracks and black swans, but what I see is disciplined quality control. Of the over $300 billion they originated, a whopping $282 billion was debt. Now look at the makeup of that debt. 80% of it is investment grade, with an average rating of single A. This is high-quality, stable, income-producing paper. Only 20% is sub-investment grade. They are not recklessly chasing yield in the riskiest corners of the market. No, they are systematically manufacturing high-quality credit assets. This isn't a sign of weakness. It's a sign of disciplined strength that basically vaccinates them from a lot of the market's volatility. And here it is, straight from the president, James Zelter. This is the entire investment thesis in a single quote. Their moat isn't a specific fund, it's not some star manager. Their moat is the system, a system that is designed to handle complexity and turn it into predictable results. The financial world is getting more complex, not less, and Apollo has built a machine specifically designed to thrive in that exact environment. They absorb complexity and they spit out high-quality returns. That Right there is the very definition of a durable competitive advantage in the 21st century. So, we've stress-tested the foundation, and it is holding firm. The core business is a fortress built on a powerful origination engine. But you know, a strong foundation is pretty useless without a blueprint for the future. So where does Apollo go from here? Well, management has laid out a very clear, very confident plan for continued growth and for shareholder returns, so let's take a look at that blueprint.
And this isn't some vague corporate speak. This is a concrete action plan. First, they have reaffirmed their guidance for over 20% growth in those all-important fee-related earnings for 2026. That is an extremely confident projection. Second, they're launching a major new strategic partnership with Schroders, which is a huge UK money manager. Third, they've authorized a new $4 billion share buyback program. And fourth, they're increasing the annual dividend by 10%. You've got growth, strategic expansion, and direct returns to shareholders. This is a balanced and powerful blueprint for creating value.
Let's dig into the Schroders Partnership for a second, because it's a major strategic move. They are teaming up with a $1 trillion asset manager to co-create products specifically for the UK wealth and US retirement markets. This is a massive expansion of their distribution network. See, they're not just hoping for growth, they are actively building the pipes to deliver it. And they're explicitly targeting a multi-billion-dollar per year opportunity here. This is how a giant gets even bigger, by forming alliances with other giants to go and conquer new territory. And for anyone out there who thinks this is just about empire building, this slide right here proves otherwise. In 2025 alone, they returned a massive amount of capital directly to their shareholders. Over $1 billion in dividends were paid out, and another $1.4 billion was used to repurchase stock. This is a management team that is clearly focused on shareholder value. They are balancing strategic investment in the business with tangible cash returns. And that's exactly the kind of capital discipline you want to see from a company of this size and complexity. Okay, you've made a strong case for the defense. I'll admit that origination engine is impressive, and the forward plan is definitely clear. So, let's bring it all together now. We've seen the bull case, the fortress, and we've examined the bear case, the cracks. It's time to weigh all the evidence and deliver the final verdict. Is Apollo an opportunity to build real wealth, or is it a trap just waiting to spring on unsuspecting investors? All right, let's just lay it all out. The bull case rests on the fortress they've built. The sheer scale is just undeniable. You have record AUM, record inflows, and that powerhouse origination engine. The 23% growth in those durable, fee-related earnings is the core of its strength, giving it a predictable cash flow stream. And the high quality of their debt, with 80% being investment grade, that provides a huge margin of safety. And then there's the clear growth plan, from the partnerships to the aggressive capital returns, which shows a defined path forward. But on the other side of the ledger, you've got the cracks. And that declining GAAP profitability is a real concern that you can't just brush aside. The net spread compression in their critical retirement business, Athene, indicates tangible margin pressure. You have the constant threat of external market shocks, like those recent AI jitters, that a company this big just can't hide from. And frankly, the complexity of their financial reporting, with that billion-dollar gap between GAAP and adjusted figures, well, it requires a high degree of trust in management to look past the official numbers. So here's the iron financial verdict. The cracks you've pointed out, they're real, and they absolutely require monitoring. The spread compression and the GAAP earnings divergence are not insignificant. However, they appear to be hairline fractures on the surface, not deep structural defects in the foundation. The sheer power and the quality of the origination engine, that long-term moat, as President Zelder called it, provides a level of resiliency and earnings power that is just exceptionally rare. So the fortress, while it's not flawless, is structurally sound. The foundation is solid. I am still wary of the complexity in that GAAP number. I really am. But I have to concede, the ability to originate over $300 billion in assets and have 80% of that be investment grade, that's a powerful counterargument to the risk case. And the blueprint for growth is aggressive, but it's credible. So for now, the fortress holds.
So there you have it. We've stress-tested the numbers, and we have analyzed the structure. We've shown you the strengths of the fortress and the potential weaknesses in its walls. Our verdict is that Apollo has built a formidable financial machine, one that is designed to thrive on complexity and scale. So, we leave you with the final and most crucial question. After seeing all the evidence, is this financial titan forged for your portfolio? Thanks for joining us on Iron Financial.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.